167-year-old financial titan completely collapsed, essentially because its leaders consistently chose to ignore objective reality. Look, we are looking at one of the most stunning wealth destruction events in modern history here, and it holds an absolutely crucial lesson for anyone trying to steer ship in today's economy. The answer is absolutely not. Just four simple words. Fired off in a single tweet, they became the ultimate catalyst that destroyed a $100 billion fortress. It sounds impossible, right? But as we're going to see, this perfectly illustrates exactly why business leaders absolutely need cold, hard facts to survive, rather than just relying on their own comforting narratives. Section 1. The 1670-year illusion. So, to really wrap our heads around how four little words could do so much damage, we have to look at the powerful illusion of absolute safety this institution sold to the world for over a century. Founded way back in 1856 by a visionary named Alfred Escher, Credit Suisse was actually built to finance the industrialization of Switzerland itself. For 167 years, this bank survived literally everything you could throw at it. World War I, the Great Depression, World War II, the dot-com bust, and even the 2008 financial crash, where it stood completely firm while American banks were crumbling. Over decades, this created a really dangerous, deeply ingrained illusion of absolute invincibility. But you know the old saying, right? Monuments don't die from earthquakes. They die from termites. Underneath that historical armor and that famous reputation for Swiss conservatism, facts were being completely ignored. Termites were quietly eating away at the bank's cultural foundation, all while leadership simply looked the other way. Which brings us to Section 2, ignoring the termites. You want to know the clearest sign a business is operating on an illusion rather than facts? Just look at the top. A chaotic, ever-shifting strategy is a massive red flag. Between 2015 and 2023, Credit Suisse cycled through 5 different CEOs. 5. Brady Dugan leaves after a massive U.S. tax evasion settlement. Then T-Jane Thiam resigns amid this, frankly bizarre executive spying scandal. After that, Antonio Horta Osrio, who's actually brought in as the fix-it guy, exits after breaking COVID rules. And finally, Ulrich Körner arrives with yet another radical restructuring plan. The crucial takeaway here is that this institution never held a strategic direction long enough to know if they were actually moving forward. Every new captain just spun the wheel, abandoning the previous plan before it could even work. And while leadership was busy playing musical chairs, the facts were basically blaring sirens through a constant stream of absurd scandals. I mean, we're talking about a $2.6 billion settlement for helping Americans evade taxes, literally physically transporting secret documents in briefcases. It's like a bad movie. We're talking about a Swiss bank hiring private detectives to spy on its own former executives. They were fined for failing to prevent a Bulgarian cocaine gang from laundering money and caught up in a Mozambique bribery scandal. Honestly, any single one of these should have been a massive reality check. Yet leadership treated compliance and risk management like it was just an annoying cost center, completely detached from the reality of their decaying culture. Moving on to Section 3, the double kill. By March of 2021, ignoring risk management and treating it as mere theater finally caught up to them in a deadly 1-2 punch that honestly stunned the financial world. First, there was Greensill Capital. Credit Suisse had packaged these incredibly complex, opaque supply chain finance loans and sold them to clients as low-risk, safe investments. But the underlying assets were of highly questionable quality. When Greensill inevitably collapsed, Credit Suisse had to freeze $10 billion in client money. The bank had actively sold safety, but the objective facts delivered a total catastrophe. And then, incredibly, literally just 3 weeks later, while they are still reeling from Greensill, a family office named Archegos Capital blew up. Archegos used these things called total return swaps to build enormous, highly leveraged hidden stock positions. When those positions moved against them, it triggered massive margin calls across all of Wall Street. And this whole fiasco brilliantly illustrates our core point about facts in business. On side A, you've got other prime brokers, like Morgan Stanley and Goldman Sachs. They looked at the cold, hard facts of the Archegos collapse, sold their positions quickly, and minimized their losses. But on side B, you have Credit Suisse. They clung to the illusion of a market recovery. They delayed. They ignored the data staring them in the face. And as a result, they suffered a $5.5 billion hit. That is the largest single client trading loss in the history of banking. $15.5 billion in client and bank money just vanished in a single month. All right, Section 4, the four-word death spiral. So after bleeding all that money through 2021 and 2022, the bank closed out the year with an $8 billion loss, its worst since 2008. The stock plummeted from a historical peak of $70 all the way down to under $3. And then came March 9th, 2023. Silicon Valley Bank collapses over in the US. Suddenly, the entire global banking system is on absolute edge. In moments of panic like that, investors aren't looking for historical prestige or PR fluff. They are desperately looking for hard facts to figure out which weak link is going to snap next. Which brings us right back to that tweet. During a Bloomberg interview, the chairman of the Saudi National Bank, who happened to be Credit Suisse's largest shareholder, was asked a simple, factual question. Would his bank provide more capital if Credit Suisse needed it? His answer? The answer is absolutely not. Those four words instantly shattered whatever remaining illusions the bank had left. Clients didn't even wait around to see if the bank was actually insolvent. The fear alone was enough to trigger a bank run. The stock plunged 24% almost immediately, and billions just started rushing out the door. Section 5. The weekend erased everything. Now, the Swiss National Bank tried to step in with a $54 billion emergency liquidity lifeline, but it just wasn't enough. Trust in banking, once it's broken, is nearly impossible to repair. And that kicked off a frantic 72 hours. Facing a Monday morning bankruptcy that legitimately threatened to infect the entire global financial system, the Swiss government forced rival bank UBS to step in and buy Credit Suisse. The price tag? Roughly $3.2 billion. Just let that sink in for a second. For a bank that was worth over $100 billion just 2 years prior, this was a staggering 97% discount. This wasn't a normal market transaction. It was a fire sale born entirely out of sheer necessity. But to actually force this deal through over the weekend, the Swiss government shocked the financial world by literally rewriting constitutional rules. They completely bypassed shareholder approval, handing CS shareholders just a tiny fraction of UBS stock. But the real shocker? That was the AT1 bondholders. 16 billion Swiss francs of these bonds, which is debt designed specifically to be safer than equity, were written down to absolute zero. It was the largest AT1 wipeout in history. And yet, even in the face of all these dramatic interventions, the government tried to spin one last comforting illusion. The Swiss finance minister actually stood up and claimed, "This is no bailout. This is a commercial solution." A commercial solution? They provided $100 billion in liquidity, $9 billion in loss guarantees, and erased $17 billion in bondholder value to make it happen. The rhetoric was just living in a completely different universe from the reality. Finally, Section 6. Why leaders need facts. The fallout from that weekend shook the $275 billion global AT1 market to its absolute core, forcing central banks all over the world to issue emergency statements. But the ultimate takeaway from this explainer isn't just about bond markets. It's about the lethal danger of corporate delusion. Look, Credit Suisse wasn't killed by a traditional market panic or some bad macroeconomic forces. It was killed because its leadership built a culture that willfully substituted ego and theater for objective reality. They operated on side A, the illusion that age means safety, that Swiss banking prestige meant permanence. But side B was the reality. Risk management was purely theatrical, compliance was totally ignored, and the strategy was effectively non-existent. They burned through their credibility so completely that when the pressure finally hit, a single sentence from a shareholder was enough to trigger $100 billion in outflows. Reality is funny like that. It will always eventually come to collect its debt. It took 167 years to build Credit Suisse and just 4 words to bring it down when the foundation had been hollowed out by ignored facts. So I'll leave you to think about your own organization, your own strategies, and ask yourself this. If a titan like this can be completely destroyed in a single weekend because they lost touch with reality, are you leading your business with hard facts, or are you just relying on comforting illusions?